Vunani Fund Managers provides institutional and retail clients with specialist equity and property management, multi-asset fund management and interest-bearing fund management advice. Tony Bell, portfolio manager at Vunani Fund Managers, joins us now to share the company's investment strategy. Give us a sense of what you look at. Let's make it as wide as possible.
Sure. The real focus back at Vunani Fund Managers is to get the asset allocation right. And what we do to get the asset allocation right is we really try and focus on the big picture and clear away as much as the noise as possible. There's an enormous amount of noise, daily press commentary, and so really we try and sort of figure out what the key drivers of the asset classes and the markets are going to be, and how to position the client portfolios within a conservative, moderate, and aggressive framework.
Yeah. So tell us, what have you been doing lately in the midst of all this noise?
It's been a little chaotic, I must confess. May was a challenging month. We saw at the start of May that the tensions were rising, and with particularly France and Greece going to elections, we saw the potential for some sort of structural shift taking place in Europe. To the left.
To the left.
A little hop to the left, exactly. Rocky Horror stuff. We're a little bit more positive and optimistic at the moment. We see the possibility of a better than expected outcome in Greece. Why? For Greece to leave the Eurozone would be absolutely disastrous. Greece would implode. And I think Germany has demonstrated its willingness to step in and commit as long as the politicians commit. So the real litmus test for us this weekend is the extent to which the politicians in Greece play brinkmanship with the Eurozone. That aside, I think Professor Cantor early on was talking about the way in which the whole Eurozone stepped in to assist Spain in its banking crisis. And that's a very positive demonstration. So we see an interesting theory emerging, or an interesting proposal emerging, with the introduction of what was very common in South Africa many years ago, the potential of a Finrand, a euro equivalent, if you like. And what that would allow Greece to do is attract interest from foreign investors at a 40 to 50% discount to the current exchange rate, and provide Greece with the capital that's necessary in order to start regenerating the growth. So from an asset allocation point of view, what I've been doing in the funds is I've taken off half the hedge that we had at the beginning of May, and we've also been positioning the portfolio into those stocks that have high margins of safety from a free cash flow valuation point of view, strong balance sheets, good underpin to earnings. So positioning the asset allocation a little less defensively now, but keeping the margin of safety high in the stock selection.
Mark?
You made a very encouraging statement about the fact that you're deaf to all this popcorn and chatter and noise. I wish more fund managers would be like that. Sadly, they aren't, or at least many market participants aren't. You have all this sort of cacophony and knee-jerk stuff. Does that then present opportunity? I mean, clearly you want short-term jobbers, but in that type of market, which we've had since May particularly, and indeed it seems like this perpetual on and off situation since 2008, how do you take advantage of that?
It's a really nice question. In April we were scratching around for value. In December last year, the value guides that we run and the way in which we look at shares from a bottom-up perspective presented a Pandora's box of value opportunity. So in December I followed a strategy very similar to what we've just embarked on. We were quite aggressive in our stock selection picks, and because the margin of safety was high, we found good value in stocks. In April we were scratching around, as I mentioned, and at the end of May, after the market pullback, a good number of quality companies had re-emerged offering very good value of 20% plus prospective return on a year's view. And that presents us with great opportunity. The balance always is to manage the systemic risk, the market risk of something going wrong with the opportunities that I see in the equity selection, because markets don't really know how to price policy risk. And what we're dealing with at the moment is the contagion effect of bad policy decisions. And so when Mario Draghi at the ECB stands up and says, it's not my problem, and Merkel says, well, we don't have any more cash to offer, the markets take fright. Spanish bond yields go up, Italian bond yields go up, and that's a very dangerous game. So we're very cognizant from a risk perspective that our clients' interests are well protected by keeping the margin of safety high in the equity selection and managing market risk through trading futures.
Yeah, you certainly, well, interestingly, one of the actions you took recently was to switch from MTN and move into Anglo-American and BHP, Billiton.
Yes.
And we were just having a conversation with Cobus Nell from Stanley, and we were talking about just how bleak things are in that sector. It wasn't a pretty picture at all. You'd have to have like a long-term horizon. Pretty much, I suppose, what you're saying in terms of how you should position yourself in this market.
Yeah. The big variable that he perhaps didn't cover, apart from the actual underlying cheapness of the stock, is it's really how the dollar plays out. If we do have a satisfactory outcome to this Eurozone, and we do find that mechanisms are put in place through what's technically known as the EFSF, and later the ESM, the European Stability Mechanism, the markets, I think, will start to normalize. Italian and Spanish rates will come down. The ECB certainly has indicated its willingness to prop up the banks through the LTRO program, so there's enough liquidity. And I think what the market is really dealing with now is the degree of systemic risk that's left in the system. If it moves towards a more satisfactory outcome, we could see a little bit less dollar strength, and that would cause these commodity companies to move a little bit higher. And they are fundamentally quite cheap, so I'm not very aggressively positioned, but I did see value opportunity in Anglos and Billiton towards the end of May.
Yeah, I'm hoping you can allow me to ask when exactly you moved out of MTN. I'm wondering whether that was around the time of the bribe allegations, or you had taken a position before that actually perhaps MTN is becoming a higher risk than it already was. Because there had already been a conversation around MTN that some of the geographies that it was playing in.
That's a really difficult one to call, because the margin of safety in MTN is relatively high. The underpin to valuation I work out to be around 120. The stock's trading at just over 130, very high dividend yield payer. And I think if one goes through all the charges that have been levied against management, our assessment is that there's quite a lot of smoke and noise. To the extent that this comes out with some real factual evidence, may impinge on the share price, but I think it's largely discounted. So the move out of MTN was really taking a position that I had put on in early May, where I had moved into MTN as a defensive play out of Anglos and Billiton, and just reversing that out.
Tony, there are multiple variables that impinge on our lives daily. Some we can mitigate if they're lousy, some we can embrace, and for companies it's the same thing, and indeed in your decision making. And the currency is clearly one. We're a very open economy. We trade over 60% of GDP. So we're pretty much like a cork bobbing on the Atlantic Ocean. And when the world has its wobbles as it's having at the moment, you short the rand. What I'm picking up from you is that possibly we're at the stage now where risk aversion may turn, that the rand may start to strengthen. A number of companies I'm dealing with, they could be sort of competitive at 6.57 to the dollar, and at 8, it's pretty okay.
Pretty juicy. It's a very difficult one to call, because I think we mustn't fool ourselves that the Eurozone solution is a quick and easy one. In my mind, I'm looking for a couple of key points in the sort of long journey that we're taking. You have to separate the sovereign and the banking issues, and you have to separate the liquidity crisis from the debt markets themselves. And so if we get through this weekend, where we have had a little jump to the left in both French and Greek politics, with the introduction of a decent mechanism to prop up Greece, and we move into an environment where the markets start to normalize their perspective on risk, we will slowly find the dollar weakening a little bit, but I think the euro is going to struggle for a while, given the magnitude of the problems that they've got. This is a long journey. It's the comrades not the Argus two oceans.
Tony, we're running out of time, but I have
No
two
problem.
quick points to make.
Yes.
One, I'm sure you were very glad you sold out of Telkom, or especially given what happened with their latest results. But
Yeah, it's a subject of hot debate at work.
That's another day. One of your top picks is
Yes.
Truworths, and you
Yes.
say here, best retailer in the world. Please justify
kidding.
quickly.
I thought that might get your attention.
It certainly did.
We ran a test with the third-party system that we use, doing a global scan for retailers, and we found that the Truworths have got some of the best metrics in the retail space. It's a company that's debt-free. In slightly more technical terms, its return on invested capital relative to its cost of capital is extremely high. And Michael Marks has done a fantastic job of sustaining those margins throughout. So it's pretty hard on a global scan to find a company that's as well positioned as Cash Flash.
But it seems
Mark,
that
have
other
you had
fund,
praise like that for
yeah,
a CEO
other fund
in a long
managers internationally share your view, which is
Yes.
why SA retail is over-owned by foreign fund managers. And it's been South African fund managers
Yes.
selling to foreign fund managers.
Yes. Of course, there's a distinction in my mind between the clothing companies and
Yeah.
the food companies. Spar, ShopRite, I think they're great companies, but I don't have any in the portfolio.
Tony, we'll have to come back and continue that conversation because
No
we've run out
problem.
of time and try and
Thank
find
you.
why everybody thinks South African retailers are the place to be. Tony Bell, Portfolio Manager at Vunani Fund Managers. And that's it for Investment 360 this evening. Thanks to my guest host, Mark Ingham, Director at Ingham Analytics.